we go, Chapter 7 or Lesson 7, and we're looking at the characteristics of bonds. And many of you probably have experienced bonds, because you would have in accounting 271, I believe, and maybe even in 272. So we're just going to review some of the characteristics, and then we have a short activity in the assignments on bonds and figuring out their present value. So here we go. Learning objectives, you're going to find out about different kinds of bonds. You're going to find out about the features. You're going to define value and how it's used, okay? You'll look at some factors that determine that value. You will estimate the value of a bond. You will also compute the expected rate of return, and then explain 3 important relationships that exist in bond valuation. And it's kind of important that you understand this one, especially when you get into the corporate world. It'll become very important. We don't need that. We'll make that go away. That's the power. We're going to look at 3 principles. Well, isn't that interesting? Principle 3 and Principle 3. I'm not sure. I think this is actually 2. So, money has time value, okay? Risk requires reward. And I think maybe that is in 3. Sorry about that. And then Principle 4 is market prices are generally right. And that's that efficient market thought. That if all the if all of the players in the market know what's going on, and have all the information, then the market price is going to be adjusted correctly instantly. So those are the 3 areas we're looking at in principles. Got key terms, and probably most of these look really familiar to you. They really should all, but I wanted you to see them because they're going to show up on the quiz. So kind of make sure that you review these before you take the quiz, just to be on top of it. Most of these you're aware of. So let's get into bonds. And bonds are a type of debt or long-term promissory note, and it's issued, and it promises that the holder will receive a predetermined, and this is kind of important, predetermined fixed amount of interest per year and repayment of the principal at maturity. So there's 2 factors, 2 cash flows in a bond. That would be that interest paid each year, and at the end of the bond maturity, the principal is repaid. So those are 2 amounts you have to not worry about, but be aware of when you try to value a bond. And who issues bonds? We can have corporations, governments, state and local municipals. And then you have several types. You have debentures, subordinated debentures, mortgage bonds, euro bonds, and convertible bonds. And the debentured and the subordinated debentures are, a debenture simply doesn't have any collateral behind it. So it's a benefit for the issuing firm that they're not tying up properties with it. Downside is it's a little more risky, so that if you're issuing it, you're going to pay a higher interest rate. The subordinate debentures are honored only after all the other claims are taken care of, if there's been a liquidation or anything. So they're at the end of the line when it comes to getting their money refunded to them or reclaimed. And then you have mortgage bonds, euro bonds, and convertible bonds. Mortgage bond has a lien on the real property. These are the value. Okay, the value of the real property is usually more than what the bond is issued for. So, yeah, if you have $1 million bond and you're putting property up against it, it usually would be at least 25% more, if not more. And then you have bonds that, a security bond, or securities that are issued to a country different from the one, I see what they're trying to say. A Eurobond, okay, is a bond that's issued to another country. I couldn't understand what they were trying to say to follow that. Such as, just because it's called a Eurobond doesn't mean it's from Europe. It could be Japan, it could be China. Japan may issue a bond to a company or into the United States. Or an American corporation in Japan pays interest, okay? So you can kind of see a euro bond is between countries. And a convertible bond is a debt that can be converted into stock or some other security within the corporation. Here's some bond terminology. You probably know all of this. And we're going to go through each one of them as we go down these slides. Claim on assets and income. This is really big. This is the priority and how they get paid with the bonds. You always want to find that out in the fine print. Your par value is the face value. Current yield, we'll talk about that. You've got coupon rate. The interest rate, that's the rate that is written on the bond, that it will pay that amount for the interest payment. Maturity is when it's ready to be, the proceeds are ready to be paid back. Call provision kind of means if you decide halfway through the bond that you want to call it at a certain price, that you can, and that's written into the bond issue to begin with. Indenture, and then bond ratings, and we're going to cover all of those. So let's go and keep moving here. Claims on assets and income. It depends on the seniority. I know that sounds kind of odd, but if a company were to go belly up, what is the order in which the bonds would be paid? Would they be paid before the common stock and preferred stock? Typically, yes. So it's really important that you understand the pecking order of who gets paid when if the company does liquidate. Par value is at face value. That's just what it sells for. And they're issued in denominations of 1,000. My guess is you already knew that. And the prices are represented by the percent, by a percent. So, if I have a bond at $1,000 and it sells for $1,000, it's selling at the face value, par. If I have a bond that's going to sell at 112%, it's going to sell for $1,120. So the percent is just multiplied times the par value to get the value or how much that bond is going to pay for at the time of purchase. It could be at 95. So you can have premiums or you can have discounts. And we'll talk a little bit more about that as we go down. And you've got your coupon rate interest, your maturity, and the call provision. And I pretty well explained those, but the percentage of a bond will be paid periodically in the form of interest, right? That's the coupon rate. So if the coupon rate is 5% on a $1,000 bond, they'll pay you $50 a year in interest. Or if it's be paid semi-annual, which most bonds are, it would be $25. The maturity bond the maturity of the bond just, is talking about the length of time until it matures or until it can be returned, redeemed. And a call provision, and sometimes those don't exist. A lot of times they don't exist. You want to make sure that you read the bond provisions. So if you read on down through here, there is also a call protection period where a firm cannot call a bond for a specific period of time. All of this is written into the bond, the initial bond offering. So that's why it's so important that you read these before you hop into them, especially in a business. And now you have indentured versus bond ratings. An indenture is a legal agreement between the firm issuing the bond and the trustee who represents the bondholders. And in that indenture, you're going to find all this information. So you really do want to make sure you read that writing. It specifies the loan and the agreement and the rights. It protects the status of the bonds from being weakened, okay, by any type of managerial action. So if you have a 20-year bond and management just is absolutely negligent, there may be something written in there that protect the status of the bonds that you've bought. And then you have bond ratings, and they reflect the future risk of potential bonds. And there are three biggies on that. There's a bond rating, Standard & Poor's, Moody's, and Fitch. And they will rate the bonds, and the higher the rating, typically the lower the interest you're going to get off that bond. But you have a lot less risk. But if you get cleared down and you're in a very low-rated bond, they're going to have to pay a considerable amount of interest to get anybody interested in purchasing that bond. And these ratings you can actually find in the Wall Street Journal as you go to the bond section, and it will give the rating so you know what kind of risk that bond is going to have. Okay, favorable factors. What makes a bond rating up? Well, it's a little bit like a credit rating when you look at it. The company uses equity to finance the company more than it does debt. And that means it will sell stock. If it really needs if it needs cash, it would rather do it through the equity side than through the debt side. So it doesn't get itself over leveraged with too much debt. They usually have profitable operations. They have a fairly steady past earnings. There's no volatility. It doesn't go up and down, up and down. It's fairly steady and moving up. It's a large firm, typically. And they don't have a lot of subordinated debt. And what the heck does that mean? It means they don't have a lot of debt that takes last place in being paid if the company gets into dire straits. So, just some of the things that help rate bonds. And then we talk a little bit about junk bonds. And junk bonds are very high yield bonds. They pay a really high interest rate. They pay 3 to 5% more than AAA rated bonds. So, they're very risky bonds, okay? You have to be careful with that. But some people like to play the bond game, the market game. And now we look at valuing bonds, and this is the fun part. So you've got a book value, you have a liquidation value, and that's a sum that could be realized if the asset were to be sold individually, just straight out. You've got a market value, what the market, this is what is booked at. Okay, this is the cost, theoretically. This is what somebody actually paid for it on our books. This is what it can be sold for out on the market. And that's what the investors are willing to pay for the market value. And then there's an intrinsic or economic value, and that's the fair value. That's the present value of the asset while looking at its expected future cash flows. And those cash flows are going to be the principal being paid back and the interest payments. So you're going to bring those back to present value. That would give you intrinsic or economic value. This talks a little bit about that efficient market. So in an efficient market, all the values at any instant, I love that, any instant, fully reflect all the available public information. And this is saying that the bond or stock, whichever, are valued correctly by the market because of this fully reflect all of the available public information. The market's fairly quick at that. And if the markets are efficient, the bond or the market value and intrinsic value will be the same. Okay, there will not be a discrepancy between the two. So it's interesting. If you don't believe that the market doesn't react instantly, watch the market sometime when a company provides a profit statement that disappoints the market. The market will instantly that price will drop on that stock, even with the hint of it. So what determines that value? So it's the present value of its expected future flows, and we all know about present value and future value, and that's what we use. We have three elements: the amount and the timing of the asset's future cash flows, the riskiness of the cash flows, and the investor's required rate of return. This is usually your market value. This is going to be dependent on the bond rating many times. How risky is that cash flow? How far out into the future is it? This is going to be looking at maturity value and the interest rate. So what we've got is future expected flows, right? We have the time to maturity, and we have the investor's required rate of return when we look at that. And this looks like this in a, if you're looking at an equation to do it, you're going to take cash flow 1, you're going to take 1 plus the rate to the first power, and that's going to be your first year. This is your second year, and this is your third year, and so forth and so on. You're also going to take into account what's going to be paid back in the end. This is the Excel way of doing it. This is a function. This is present value. You plug in the rate, you plug in the periods, you plug in the interest payment, and you plug in the future value, which will be 1,000, and that will give you the present value of a bond. So if you're looking at this typical flat cash flow for a corporation at time 0, at the time that it's sold, there's a cash inflow, okay, where they've borrowed the money and the cash comes in. From 1 to maturity, they're paying interest out, okay, and at maturity, they repay the principal, and that's, with the exceptions of bankruptcy and other things that could cause the bond to not be redeemable. And now this is the cash flows for the person who holds the bond. Okay, they pay out that money, and then they receive cash from 1 year to maturity, and then they receive the par value back. So those are your cash flows. And here's an example of a bond valuation. This is Toyota. 2010, that's the maturity date. A coupon rate of 4.35. December, there's 5 years left on the bond to maturity, and the investors owning the bond are requiring a 3.6 rate. Well, it's written at 4.35. The market only wants a 3.6 rate. So you have to, first of all, my interest rates are always going to be at 4.35, 43.50 every year for 5 years. The par value is going to stay the same. It's at 1,000. What is going to be a little bit different is when we start looking at the present value, because of the difference in the required rate. So for the bondholder and for the corporation, how much is this thing going to cost right here? These are our cash flows that we have to bring back. And this, okay, is calculation for it. You've got $43.50 for 5 years at a rate of 3.6, because that's what the required return. You have $1,000 in year 5 with an interest rate of 3.6. It's going to be returned. So you're looking at the present value of an annuity, which is the top one right here, and then you're looking at the present value of a single cash flow, which is the principal. If you find the factors and multiply this out, you're going to find that the actual interest payments are worth $195.84, and the single payment of $1,000 is worth $837.73. Add those together, and you have the present value of the bond. Now, if you do this in Excel, you would do it in 2 steps. No, you would do it in 1 step. I'm sorry. You'll just plug that information. Where did it go? You do it in Excel here. If I take this, let's just take this and move it. Copy, and let's take this down to our example. Where were we? Here? Yeah. So, if I can paste this down here, let's see what we got going here. So in this situation, the function, the rate would be 3.6, the periods would be 5, the payment would be the $43.50, and the future value would be that $1,000. And this function would do all of the calculations for you and add these two together to give you the present value. So you could do it by hand, or you can use Excel. I have everything set up in Excel for you. So, and there's something called yield to maturity, and that refers to the rate of return the investor will earn if the bond is held to the maturity. That's also known as the expected rate of return. Now, don't get that mixed up too much with required rate of return, because expected rate of return we can use in a different sense at times. So the yield to maturity equals a discount rate that equates the present value of the future flows to the current market price of the bond. So again, you're using current price, time left to maturity, par value, and the annual interest rates. All of these figures are very, very easy to manipulate, because they all fall under the same type of calculation. So you're going to look at the current yield on a $1,000 par bond at 8%. Market price is $700. So what you compare, okay, what you're going to compare is the interest payment with the market price, and the current yield, okay, dividing the interest in by the cost, the current market rate, it's going to give you the yield, the current yield. This is what it's yielding. So if you look at the total yield, now this would be if you sell it at this time. If it was bought for $700, it was sold for $725, and you had this $80 payment in there, you would take the $80 and get the profit of $25, which would give you $105, and divide that by $700. That would give you a 15% yield. So the current and the total yield are a little bit different as you look at that. So there's 3 really important relationships you need to be looking for. And the relationship 1 is the value of the bond is inversely related to the changes in the investor's present required rate of return, current interest rate. As the interest rate increases, just look at the increase part, the value of the bond decreases. There's an inverse relationship. So that's one relationship. 2, the market value of the bond will be less than the par value if the investor's required rate of return is above the coupon rate. The bond will be valued above par if the investor's required rate is below the coupon rate. This is where you come up with a bond sold at a premium above par or at a discount below par. This is where you come up with that premium and discount rate, or discounted bonds. And that's just what it tells you here, discounted and premium bonds. And that's where you'll end up amortizing the difference, because that affects the seller's interest expense as you go along. And we're not doing accounting here, but I'm sure you have struggled with that. And then the third relationship is long-term bonds have a greater interest rate risk than short-term bonds, and that's why you're going to have a higher interest rate on a 30-year bond than you do a 3-year bond or a 5-year bond. A change in interest rate will have a relatively greater impact on a longer-term bond. So, and that's because it stretches over so many years. So keep that in mind as you traverse the bond world. Now, the main risk for bondholders is changes in the current interest rates. Okay, nobody wants to be holding a bond rate that is at 5% and the market is paying 10%. That's awful. You just feel really frustrated with that. The default risk, possibly there's a bankruptcy, or there's a call risk. What if they call the bonds and it doesn't go as long as you wanted it to? So those are the risks. And these figures are just kind of nice because it tells you the asset characteristics, the investor attributes, okay? And these two come together to develop or create the investor's required rate of return. So these on the side are the main factors that really drive the market's interest rate for bonds. And finally, we have the data that's required for bond valuation. You might want to print this. You'll find it in the book, or write it down because it's really very good. You're looking at, this is what you need, the interest rates, the principal, the term of maturity, and then the required rate of return. And you are good to go with bonds. And we have a really nice, I think, exercise in 7.1, and I put that all in a spreadsheet for you. So all you have to do is do the spreadsheet and answer the questions. So have fun with this. I thank you. Have a good evening.